Welcome to the insurance series. I'm William Freitas from Confio, and today we've got Anthony. Anthony, welcome to the show.
Thanks, Will. Good to be here.
Anthony's from the Everest Risk Group. He's an advisor as part of the Insurance Advisor Net Group, and someone we partner with quite a bit. Anthony is someone that I've looked up to for quite some time. He's been part of the Insurance Advisor Net network for how many years?
Oh, geez, over 15 years. I think 20 years in total. Yeah.
20 years in total.
Yeah.
And so, having been part of the Insurance Advisor Net network myself, Anthony, I've sort of spoken to Anthony a few times, bounce ideas off Anthony when speaking to different clients. And so it's always been a mutually beneficial relationship. And today I'm excited to bring on Anthony because we'll chat a little bit about property, I guess, and that's, a lot of what you do. But also, what has Anthony tick? What had you be in insurance? That's always our first part, which we really like to get into. So, Anthony, take it away. Tell us a little bit about you and what you do and how you got to where you are now.
Yeah, I think the usual story in insurance is that we all fall into it, don't we? It's like many other professionals in our industry, but I kind of came out of university and finished in 1999. I had an economics degree majoring in marketing and thought I'd be the next big marketing executive, but there wasn't many jobs in that space at the time, and I think the first job that I got offered was in insurance broking. I thought, this sounds like a career path that I could take forward, and been doing it since year 2000 since. So been a very rewarding career and got a great client base. You get to meet some great underwriters and obviously colleagues like yourself. And it's a great industry to be part of for sure.
Kind of just fell into insurance like everyone else, sort of thing.
Yeah, absolutely. Just again, first sort of job that I applied for that I could see sort of a career path through, and saw it as a true profession. Thought I'd go for it, and the years go by and you sort of build your technical expertise, and it's kind of too late to turn back.
Yeah, and look, it's a common trend in the insurance industry, right? Like it does lay down a pretty good career path for you to go, okay, well, if I put my head down and I apply myself and work hard, I can really make something of it, right?
Absolutely, particularly in Insurance Advisor Net, where you can run your own business and apply all your technical knowledge, for your own benefit and future, which is an awesome perk. Yeah, absolutely.
And what is it about insurance that you enjoy?
I guess I just like dealing with my clients. When you've been doing it for as long as I have, they sort of become your friends, not just your clients. Making sure that you're setting things right up for them. And, when you do get that call at 2 a.m, which has happened on a few occasions in my career, you're there to take the call and let them know, look, everything's going to be okay. You're fully insured. We've set up everything correctly. We'll get the assessors and the claims preparers out there tomorrow. And you're just sort of giving them that comfort that from day one that, everything's going to be okay. It's going to be stressful, but everything's going to be okay.
It's crazy the impact that an insurance advisor can have on, one, not only a local business, but to the broader community, right? Sure. I know when I started Confio, that is very much what drew me to Insurance Advisor Net in general, the community aspect, but just in business in general, what I wanted to be was the advisor that could support their friends and their broader community. And you said that as well, and so I find that really interesting.
Yeah, I think what we offer, Will, as part of the Insurance Advisor Net community is that, we're on the ground. We're not this call center approach or people that can't be accessed. All our clients have our mobile phone numbers. They know us personally, so they can put faces to the names and understand that, they're buying insurance from someone they trust, and someone that can understand their business intimately and reflect that business into the insurance market and ensure that not only the price is right, but the cover is set up for their specific risk profile for sure.
Yeah, and you mentioned the word personal. I do think business is personal, right? And when you get to know these clients so intimately, you do become friends. So that's what I love about insurance.
Yeah, it's the real trusted advisor piece. The client goes on the journey with you and they trust you, and you exchange the information that you require, and you go into the market and you do the best thing you can for them. And conversely, when the claims happen, that's where the rubber hits the road, so to speak, and that because they've given you the right information and there's that true trust on both sides that the program is being set up correctly and it's there to do what it should.
And so let's jump into property insurance, right? It's not always the sexiest, you would say, but it's so vital, right? It's the thing that everyone needs to protect their building. And naturally, there are varying different levels of property insurance, and you can probably talk to this to some degree. Depending on the size of the property, you might cover it under a business package insurance policy, for example, or you might have an industrial special risks policy, right? And that's something that we'll talk about today. But tell us a little bit about, I guess, ultimately the landscape of property insurance, why one client would be one, not the other, and what the differences are.
Yeah. So a business package was invented to create multiple sections of cover so a client can tailor cover to its own risk profile and its own individual needs. So a business package won't just have property-based insurances in it. It'll have public liability insurance. It can have employee dishonesty cover. It can have a whole range of section cover. Some of them have up to sort of 12, 14 sections of cover, which the client can elect to take or not take. But typically it's for smaller clients with smaller asset values or at single locations, where the industrial special risk policy was really invented for large clients that have multiple properties or large declared values. Typically the values insured in the market at the moment to qualify for industrial special risk are typically sort of, the old standard was sort of circa 10 million, but probably some are over 5 at the moment, but anywhere between that sort of 10 mil plus is the sweet spot for an industrial special risk program to be formed. The origins of that program sort of come out of the sort of 70s and 80s, where each major international broking house had their own sort of policy form, which got very unwieldy for the market to underwrite for, because each of the wordings were so disparate and different. So the industry as a whole developed what's called the Industrial Special Risk Mark IV to essentially come to a market standard of what an industrial special risk policy would look like. From there, a whole range of endorsements were developed to be able to tailor that policy to a certain industry class, or to make the policy broader, or to take cover away. So the broker, the client and the insurer could essentially negotiate on the cover that they require.
And so the coverage provides both buildings coverage and business interruption coverage, right?
Correct. It's in 2 sections. So section 1's called material damage, which covers declared buildings, contents, stock. And then you've got section 2, the consequential loss business interruption section, which will cover the ensuing loss of gross profit, loss of revenue, or loss of gross rentals that could ensue from damage that occurs at the site.
And so it's interesting, I mean, from the historic element, just to confirm, it's not just an Australian thing, right? It's a global thing, the Mark IV? Or is it just Australia?
I think there is equivalence overseas, but I'm pretty sure the Industrial Special Risk Mark IV was a Australian-based form.
Yeah.
There may be some adoption overseas or things that were taken, but my understanding is it was an Australian form.
And in some instances, for example, you might have London insurers who write on a Mark IV
Correct.
wording, which we're negotiating.
Yeah, look, it's a widely adopted wording. It's very well understood because there is a lot of case law in Australia. So as a result, it's well understood by the market, both overseas markets and local markets. So from that perspective, because there's so much case law on that form, it's very easily understood and easily advised on as a result of that. So it's a form that I'm very comfortable with and can advise, pretty granularly on as a result of that.
And interestingly, given that it's the one product across multiple different insurers, what differentiates one insurer to the next? I mean, outside of price, naturally, you're going to have some, claims handling capabilities and the like, but what else?
It can be anything like, some insurers have the ability to tailor wider endorsements. So if you want a specific endorsement for a specific industry set, they might be more willing to negotiate that endorsement, whereas insurer B may say, no, we can't provide that, or it's not something we look to provide cover for. So when you prepare these industrial special risk slips, as we call them in our industry, to go to the market, it's important that any specific endorsements that you want for that industry subset are articulated to the underwriter, and they're aware that that's what you want added to the cover.
Yeah. So what are some of these endorsements as an example? I mean, ultimately, some of these clients might not be aware of these endorsements naturally, so you've got to work with an advisor who can advise them on this.
It can be anything like, hotel clients will have endorsements to cover property of guests and lodgers, for example. There's a specific endorsement to cover property of guests and lodgers in case there's a massive fire and the guests lose their personal items and somehow they're held responsible for those items, or the client themselves, the customer themselves, don't have insurance covering their own goods whilst at the hotel. The industrial special risk policy can be broad enough to provide some nominal cover for the guests. It can be things like flood cover. The standard industrial special risk Mark IV policy will have an automatic flood exclusion. So typically flood cover is available for up to sublimits. Normally we can get $500,000 worth of cover without too much trouble, unless you're on a floodplain or a predetermined exposed flood zone. So you get an endorsement to cover the flood. Again, I normally try to get flood cover as much as possible, just to avoid that argument between is it flood, is it storm, is it runoff water, is it storm water, all the other arguments that you can get. So if you're not in a flood zone, I always recommend to buy the flood cover, because typically it's thrown in without too much additional cost, particularly in a softer market cycle where if the underwriters determine that you're not on a floodplain, they typically will throw in cover without too much of a financial impost.
And is $500,000 generally enough for flood coverage?
I mean, you need to obviously play every risk on its merits, but typically if you're not in a flood zone, $500,000 is a good amount of cover. But again, you need to obviously apply it risk by risk, and obviously the larger the risk and the more property exposed at that location, you would obviously look to do a risk analysis exercise with the client and work out, okay, if something did happen, how much would you lose? If you knew the flood was coming, could you raise the stock, or was the stock already raised up 3 or 4 metres above a certain height? So therefore, even if it did come, we're not likely to lose more than $500,000 anyway. Yep. So you have to plan that sublimit with the right interaction with your client by understanding that risk profile. Yeah.
And it's just under Section 1, that endorsement, right? It's not across Section 2 as well?
You will need typically with flood, if you have it under the material damage section, you will also qualify for the ensuing business interruption as a result of. So the business interruption is predicated upon a material damage loss being paid by the insurer. So without a trigger under material damage cover, there is no trigger under the Section 2 cover typically. There is some examples with some contingent business interruption losses where a material damage trigger at the insurer's location is not required. I can get into that if you'd like. But,
Any particular examples?
Yeah, there's things like customers and suppliers premises extensions, where you can buy, if you imagine you're the old widget manufacturer who manufactures widgets, and there's a certain component part that they import from a supplier overseas or a supplier locally, and that's the only supplier that manufactures that part that they need to make the widget with. And so if that supplier has a material damage claim, so like a fire, which means they can no longer supply our insured, the insured would have a valid business interruption claim under their industrial special risk policy.
Yeah. So the supply chain risk.
The supply chain risk, correct. Yeah. So in that case, the policy does respond for contingent business interruption where the loss doesn't necessarily occur to their insured property, but to the insured property of their supplier or customer for that matter.
And take us through, I guess, some of the underwriting mechanisms or considerations that underwriters would have, right? It's interesting that you mentioned the history behind how the Mark IV solution came together. I can imagine it would have been a headache for underwriters to go, geez, well, which wording are we on? What's covered, what's not covered? What can we include coverage for? What are some of the mechanisms now, given that it's a standardized wording, that they look for in terms of risk management and making sure that they are comfortable with the risk?
Yeah, I mean, obviously, certainly for larger programs, or essentially, I think my view, anything that has an industrial special risk, any client that has an industrial special risk program, really should have a qualified risk engineering survey on file. So, the broker should have thorough information about what we call COPE, so construction of the premises, the occupancy of the premises, what the occupant of the tenant or insured is, the protection of the premises, things like, does it have a back-to-base fire alarm? Does it have a sprinkler system? So the underwriter can understand the severity of what might occur if a fire breaks out. Will it be contained by the sprinkler system, etc.? And then the exposures, which is the E. The exposures can be anything like, is the neighbour's premises a highly hazardous tenant that could cause a large loss that could knock onto our tenancy, for example. So once you have all those basic information, you can build the story and show the insurance market what the risk is about, and negotiate the best possible terms based on that risk profile. Without that kind of quality information, you'll find it very difficult to obtain alternative terms. And even if an insurer does quote, they'll usually quote on the side of caution, loading premiums, higher excesses to give themselves comfort if you don't have the quality information.
And some insurers will quote subject to having their own survey, right?
Yep, absolutely. My view is surveys are things that the client and the broker should control as well. Have that information in your own hands, so you don't become beholden to the incumbent underwriter all the time.
Yeah.
And ensure that you have that information. So if the incumbent underwriter decides to change the ball game, or you're not happy with pricing or the wording, you've got quality information that can go to alternatives, and you can ensure that the client's risk profile is well understood by the broader market.
And to some degree too, you get ahead of the curve, right? If there are some key risk mitigation measures to apply, you can do that before you speak to the insurers.
Yep.
Because if you go and speak to the insurers, sure, they can still amend their perspective, but it's a slightly different negotiation, isn't it?
Yeah, no, absolutely. If you get your own risk engineer out there that the client pays for, the risk engineer will make its recommendations. Typically, they're very practical. My experience with the risk recommendations, they're typically quite practical and low capital expenditure. Like they don't necessarily make someone that doesn't have a sprinkler system go and install a sprinkler system. Obviously, that's a capital expenditure that's way too great.
Yeah.
But typically things can be like implementing a hot work permit. So if you've got some sort of manufacturing process that has some sort of welding process, or ensuring that you have the right permits in place to risk manage that welding process, because you don't want a bad weld leading to a catastrophic fire. So typically it's just housekeeping stuff that comes out of the risk engineering process, which allows, and the risk engineering process is really there just to take out sort of as much risk as you can that you can control. So the internal housekeeping risk. You're never going to control natural perils. You're never going to be able to control storms, hail, all the rest of it. All you can do is ensure your building's resilient enough to cope as best you can. Ensure your gutter is clean, or your normal risk management. Sure.
The only thing you can measure with natural components is where you place your property, or where you purchase your property.
Yeah, absolutely.
Outside of that, there's not a lot that you can manage. Now, talking about construction, and I know this might be sort of basic 101, right? But what are some of the key materials that people need to be mindful of? Naturally, there's things like EPS, which as an industry, we're very well aware of what EPS is, but some of the listeners might not be fully aware of what EPS is. So,
EPS has been a difficult one to get across for the industry over many decades. So EPS stands for expanded polystyrene paneling. So it's essentially two pieces of metal with some foam between it, which is typically used in cool room processes. It can be used for in laboratories to make clean rooms. So it's a very low cost, quick construction, easy for cleaning, great insulation properties, but very flammable. Essentially, any sort of ignition point, it's very difficult to stop the fire, and typically when large EPS fires happen, the fire brigade's mandate is to protect life, because there's not a lot they can do to protect the property.
Yeah.
So they just try to keep it all down, and they essentially you just can't stop it.
And most insurers sort of operate on a percentage basis, right? Like a small cool room in the back is fine.
If it's incidental, a small footprint in terms of the overall footprint of the premises, then most insurers will treat it as very incidental. But as soon as it becomes more than typically, I think the threshold is 20%. Some underwriters maybe up to 30%. You start to get complicated engineering out there to calculate the surface area of how much the EPS is occupied by. Each insurer has their own way of doing it, how they calculate it. So it's EPS risk needs lots of risk engineering and lots of forethought to manage the market as it goes through its hard and soft cycles. Because if you miss the market hardening without the right information, the cost can really start to escalate for a client quite quickly.
Yeah, which can make a real difference in their bottom line, naturally.
Yeah, capacity can become an issue too. So you've got, in a softer cycle, if you've got a $50 million cold store, that's essentially all, EPS, could be exposed to EPS. You might find one year the holding insurer says, well, I can't put out that capacity anymore. You need to find another 3 or 4 insurers. And then all of a sudden, if your broker's not ahead of the game, the client doesn't have the right risk engineering, you can find yourself in a huge hole and not have enough insurance.
And you're sort of alluding to the time that it can also take, right, in putting together these programs. Some clients often can fall into the trap of starting too late, whether it's 2 to 4 weeks prior. I mean, these programs need to be starting a lot sooner, right?
Yeah, anything with EPS, and I have a few manufacturing clients that have some exposure to EPS, but certainly no cold stores. But those programs need to be started sometimes 6 months prior to renewal.
Right.
To ensure all the risk engineering is done, all the risk recommendations are presented to the insurer and ticked off. Sometimes you might need to see multiple insurers because, again, there might not be capacity in the market to write the entire risk. So you may need to involve 2, 3, 4 insurers sometimes to place the entire risk 100%. And they'll obviously share in the claim. If a claim happens, they all share in it proportionally to their subscription. Yeah. So it is important that EPS is well managed. There is other less flammable things like PIR, which is more tolerated by the market. But typically my experience is they treat all paneling almost the same. Yeah. Unless you can really get some really hard facts and show, obviously newer builds are a lot easier, because I guess if you're doing an EPS paneling now, you wouldn't be using the old EPS, you'd be using the more modern materials, which is less flammable and more tolerated by the industry. So if you could show that to the insurer, take the material data safety sheet to the insurer and describe the risk, and they're really comfortable that it's been manufactured under current standards, you're more likely to get a better result.
Yeah, no, agreed. Talk to us about occupation. So we've worked through construction. Let's go through occupation. Naturally, it's the obvious is if you're a property owner, for example, and you have a particular high risk occupation within the building as a tenant, that's a consideration. But talk to us about the surrounding occupations as well, and how that sort of impacts the risk or at all.
When you say surrounded, like you mean the neighbouring properties?
Yeah, the neighbouring properties.
Yeah, I mean, obviously when the underwriter underwrites the risk, they're looking to work out what natural perils are doing in that region. Is the area exposed to hail, flood, storm damage, and they'll obviously use their actuarial data to work out what that area does, and then they'll drill down deeper. Okay, well, what's the tenant do? Is it a hazardous tenant? Are they manufacturing fireworks, or are they just a clerical office risk with very little additional fire load? Yep. And obviously they will look at neighbouring properties as well. Like for example, if you're if your nearest neighbour is a manufacturing risk that has lots of fire load, like large manufacturing machinery exposed to high electrical loads. Obviously high electrical loads can sometimes lead to electrical fires. They might, adjust the rate to take into account a fire that could occur to a neighbouring risk that could knock on and cause a fire to you. Sure.
Yeah, cool. And let's go on to protection. Sprinklers seems to be the hot topic, right? Naturally, there's more to it, but give us a little bit more insight into protection.
Yeah, I mean, sprinklers is, every insurer would, I guess if they could, would write a fully protected sprinklered risk for, obviously, to lessen the fire load and all the rest of it. But that said, there's certainly ways for unsprinkled risk to still provide protection. There's, back-to-base smoke, fire detection systems. So there's a lot of other ways to sort of try to get to early detection. So whilst it's not going to necessarily suppress the fire, it'll obviously, the alarm will notify either the local fire brigade and get there a little bit sooner. Yeah. So they're all the kind of protection measures, obviously for security risks as well, ensuring that you have the right alarm systems, even things for, sometimes industrial special risk policies can be extended to cover machinery breakdown risk. So alarm call rooms, when the call room's temperature drops by a certain temperature, it sort of sends out an alert. So to ensure that the deterioration of stock doesn't occur, which can also be a loss. Yeah. If the industrial special risk policy is correctly endorsed.
Okay.
So yeah, the more you can show that the property is adequately protected, arguably you can show the insurance market that the risk should be, more appropriately rated and more competitively structured in terms of premium for sure.
And interestingly, what clients really need to understand is when you get a risk engineer and when you frame this in the right light to an insurer, it can get you a better solution. So it's a little bit of obviously an investment up front, but it gets you a better solution. So it's getting your front foot on the front foot and getting in the right action.
The underwriters are essentially charged to deploy hard-earned shareholder capital that these insurance companies are managing for their shareholders to the best possible risks, and to ensure that they obviously make their profits for their shareholders. So the more you can give them the comfort that your client has done all the right things, demonstrated that with hard data, risk engineering surveys, for example. You've demonstrated a good claims history, or where they've had a claim, how they've addressed that claim, as in, that claim can't happen again, or the severity of that claim will be less this time because the client's implemented X, Y, Z to ensure that claim will be more well managed and risk mitigated.
Let's go into claims. You briefly mentioned it previously, getting a phone call at 2 a.m. and sort of giving that client the reassurance that the policy's in place, the policy's correctly structured, and that we'll get the loss adjusters out there tomorrow, for example. But post that, what's the process that brokers or advisors can really assist clients in?
Yeah, look, to be able to have that conversation at 2 a.m. to tell the client that everything's going to be okay, it's really in the setup process of the policy. And the key thing for me, along with a risk survey, is particularly if there's substantial building holdings in the industrial special risk program, is to ensure that independent quantity surveying reports are taken of the building itself. We shouldn't be using real estate values to insure buildings. You should be insuring for its replacement value to rebuild. So a quantity surveyor can obviously use the right quantities required to bricks, whatever, to reinstate the site. The quantity surveyor's report will have things like, how long it's going to take to rebuild, which the client can then use to determine its business interruption indemnity periods. So, for example, if the quantity survey says this building will take, including council approvals, 18 months to rebuild, you really shouldn't be taking business interruption indemnity periods for 12 months because you're going to be getting to the 12-month mark and your building still won't be reinstated.
And you can't continue operating.
Well, essentially, yeah. And without adequate business interruption insurance, having too short of an indemnity period is also a form of underinsurance.
Yeah.
Not only not insuring your building for its right value.
Yeah.
I always tell my clients that, great, you've got material damage insurance, but if you're not protecting the asset, that the essentially assets of the buildings, the income that those assets produce, you've only got half a solution. So we're all in business to essentially look after our families and pay our bills and look after our own staff. Mm-hmm. So without those assets in play, we need to ensure that they're adequately protected by the right business interruption insurance.
And so before we go on to claims, let's talk about business interruption really quickly in terms of how you calculate that limit of insurance, right? Because there's a pretty technical approach as to how you go about it, looking at a set of financials and getting a feel for what they need, but also adding on additional extensions like increased cost of working,
sure.
Right?
Yep.
What are you seeing in that space? How do you go about it? What's your process?
Yeah, it's very important because as an insurance broker, the business interruption section is probably the only section where we can actually have input on its calculation. Obviously, we can't tell the client what a building should be rebuilt for. That's not what we're trained to do. That's what quantity surveyors are trained to do. So if you need to get that, you need to engage a quantity surveyor. But with business interruption, it all generates from the financials. Like in the event of a large business interruption claim, the first thing the loss adjuster will come in and ask for is proof of loss, and that would mean going into the client's accounting system to essentially go back in time and work out, well, for that period that was interrupted, what normally does the revenue do in those months? What are the normal expense functions? What expense functions does the client still have versus those that are saved? And then making the calculation for what the business interruption insurance is. So typically for most clients, you start with revenue, you will subtract cost of goods sold, and then identify any other variable expenses that vary in direct proportion with the reduction in revenue. So things like freight typically can come out and don't need to be insured. But your gross profit insurance is very different to accounting gross profit. Gross profit for insurance purposes will always be invariably greater because the insured wants to continue to pay any of those fixed expenses. And in the event of a partial loss, most expenses continue. They don't tend to all abate.
Yeah.
So it's only with an insurance broker that you're working with that you trust, that knows your business, with the exchange of the right profit and loss information and them understanding what you would do in the event of a loss, then they can determine and help you determine what the gross profit should be for insurance purposes, and then also give you advice on a longer indemnity period, particularly if there's reports saying that your building's going to take 2 years to rebuild, and it could take you another 6 months after that to get your market share back or get your customer base back that you've lost. So perhaps 24 months might not be enough. You might actually need to take a bit longer than that to ensure that after the building is built, you still have that time to go out there and remarket the business and get all your customers back. So.
And there are often some additional expenses that people don't really factor in, right? A cow is the word they use, and no, that's not a cow as it sounds, but it's additionally increased cost of working, right?
Sure.
Something that isn't always necessarily reflected in financials because they're as it suggests, additional expenses that are as a result of that claim that you need to incur to be able to continue to operate, right?
Yeah, and additional increased cost of working is, it's not something that can be gleaned from a financial statement, but it is something that can be talked about with the client. So, in the event you're building, if you're a tenant, if you're building, you can't rent your building anymore, what would you do? Would you go and rent the building down the road? Or, what would the rent be there if it's an additional, $200,000 or $300,000 a year to rent that building? Well, that would be the additional increased cost of working supplement, for example.
Yeah.
But essentially, additional increased cost of working supplement can be essentially calculated by doing a disaster recovery plan.
Right. And what does that look like?
Essentially, exactly as the name sounds, you would sit with your team, your senior management team, and work out what your disaster recovery plan looks like.
And it's not something that brokers would put together, right?
Brokers can have input, but there is specialists out there that can put DRPs together. Some clients like to do it for themselves. It can be as simple as a one-page document, and obviously more sophisticated businesses like Coca-Cola, I'm sure there's a 50 to 100-page document perhaps. But through that process, you should be able to identify, in the event of this major loss, we would do this, this, and this, and we would need this much more additional cash to go and rent this premises, or we would contract manufacture for a while and they would charge us X per month, or you would go through all the various scenarios and develop what a reasonable additional increased cost of working limit should look like.
And it's like what you said at the start, right? The ability to comfortably tell your client that it's all good, we've set it up correctly, is very much in that instance, getting a feel for what the disaster recovery plan might look like. If there's no disaster recovery plan, at least discussing with the client around how it is that they would want to utilize the insurance when an event occurs. It takes out the guesswork, right? It takes out, do we have this coverage? Do we, can we make this expense? Or how do we go about this approach? How do we respond? It definitely improves the claim process, right?
Yeah, typically I always have additional increased cost of working as an agenda item at pre-renewal review. We always sit down with our clients. We don't just sort of take what was done last year and assume that it's right forever. We have it as an agenda item, we talk about it, I explain what it is. So it's, the way I explain it's essentially a blank check from the insurance company to spend money on anything you need to do to avoid, to get you back into business sooner, essentially. So it's a very powerful cover. And through that process, normally those insureds that are smaller or less sophisticated, we can almost run a little disaster recovery plan on the spot, just through their business owners' understanding of their own business. Well, we'd do this, we'd do that. That'll probably cost us about that. And then we sort of formulate it on the run like that. So sometimes even just having that conversation is enough for the sort of a basic TRP to be sort of put together.
Yeah, no, perfect. Well, look, let's go through some claims examples. I mean, naturally, you've been in the business for quite some time and you would have seen some juicy claims, and I think this is what everyone likes to go through. So do you have a claims example you could share, obviously without sharing names?
Yeah, and the most recent one has probably been a large property owning group of mine. They again contacted me at 10 p.m. at night. This is many years ago now, but essentially they had a tenant that essentially sold batteries for cars and that sort of stuff. So the industry is really struggling with battery technology, lithium ion, as well as the more traditional batteries in cars. They're obviously very difficult to put out. So it's when a fire occurs, they are very flammable sort of items. So anyway, this client's tenant was a battery weld. Something was left charging overnight, and the whole store caught alight. It knocked on to various tenants because it was a large bulky good warehouse essentially. So it knocked on to neighbouring tenants that were in, one was an Office Works, for example, that just sold stationery and stuff, and there was a Freedom Furniture place and that sort of stuff. So not only was that whole the tenant itself demised, but all the smoke damage, all the sulfuric acid that sort of vaporised, sort of landed all over the building. So essentially it was almost to a point where the whole building was almost a total loss. So yeah, like in that process, the amount of experts that were involved were absolutely crazy. We had hygienists to understand whether all the metal pylons in the tilt slab construction, whether they were they affected enough by the sulfuric acid or not? Were they still suitable to be used and not used?
Right.
So yeah, on these large losses, the amount of experts that actually come in to provide reports are extensive. The indemnity period there was quite spot on correct, because again, we had the quantity of surveys to report. So as a result, the indemnity period was spot on correct, because the building was reinstated well prior. So the client had no loss of rent or anything like that. All their rentals were covered from
How long did it take?
the insurance. It was a 22-month reinstatement.
Okay.
It was a very complicated loss due to the sulfuric acid, because then it affected the concrete slab. So the concrete slab had to be excavated down and new Rio implemented. So yeah, it was a very frustrating loss from that perspective. It almost would have been better if it was completely burnt to the ground in some respects. Probably the return would have been a lot quicker. But yeah, that was just sort of how it occurred.
And I guess what was the ultimate loss in terms of cost? Well, what did that look like?
It was a circa $12 million loss with business interruption and the actual reinstatement of the building itself, air conditioning systems, engineering systems.
And obviously the business interruption piece will cover the gross profit, as we've said, or the insurable gross profit.
Yeah, it was rent in this case because it was a property owner.
Yeah, correct. Now, for many of those, businesses that were in that premises, if they can't operate in that space, they naturally have to have their own insurances, right?
Correct.
And that's something that needs to be, there needs to be that clear distinction where they might have to move their business elsewhere because they might not be able to operate. So the property owner less so of a risk of loss of reputation, like they get to rebuild the premises and then they get to rent it out again, right? Whereas the tenants within that need to think about what they're...
Yeah, absolutely. I mean, particularly with a bulky good warehouse where you've got like a whole bunch of all different retailers all in the one complex, you might find that, if you don't go back into that area, you may not have the same revenue return because that area was a draw card premises. So, you're going out, you're moving into a new apartment, you want to go and buy your furniture, you go to one tenant, and then you go to another one. So if you're no longer there because of the fire, even if you do relocate somewhere else, you may never regain that same level of trade you had.
So that's what I love about insurance, right? It's so multi-layered. Like there are risks within risks that really need to be considered. When you're going through an insurance program, it's not as easy as buying an ISR policy off the shelf. Not that you could, but you really need to be aligned with an advisor who can talk you through this and explain to you what the key risks are.
Certainly the more experienced advisors that have been through claims and able to give you those scenarios and allow the client to see what could happen and then let the client make an educated decision on what they'd like to do and how they'd like to buy their indemnity periods. Is 12 months enough? Is 18 months okay? Or do we need to go longer? Or, how often do we get a revised quantity surveys report for the building? Like obviously building costs have skyrocketed since COVID with all the supply chain issues. So just because you insured your building for $1 million 5 years ago, it's that wouldn't be enough now, for example. So in the event of a major loss, the policies have underinsurance clauses. So, for example, if you're 50% underinsured and you have a $200,000 loss from $1 million building, the insurer might only pay you half that loss. I mean, I'm generalising. It's not normally that hard and fast. The wording will have some tolerance for underinsurance, but to keep it simple, 50% will be borne by the insured by not declaring the full values at risk. Yeah,
and that's a key risk, right? If they're not considering how that will impact their DRP, it can make a significant difference to the end result.
And some insureds are don't understand the policy. They think, well, I only have to insure for my maximum probable loss. Well, that's not how the policy operates. The insurer must be given the right to underwrite the risk on its merits, which it's the full values at risk. So should the insured elect to not insure for the full values at risk, essentially the insurer is saying, well, you're actually the insurer for the portion that you didn't insure for, in a way. So it is important that insureds understand that you can't just say, oh, I've got a $10 million building, but the worst possible claim is only going to be $1 million, so I'll just insure for $1 million. It doesn't. Policy isn't set up like that. The insurer must be given the right to underwrite for the full values at risk.
And this is probably a tough question, given that it's such a traditional line of insurance. But where do you think property insurance will go in 5-10 years' time? Do you see it changing? Obviously, the Mark IV has been around for quite some time. Will claims handling be impacted by the addition of technology? What are your thoughts?
Yeah, look, I think there's obviously going to be a huge role for AI and things like drone technology, for example. We could, with AI soon, I think you'd be able to probably throw a drone over the top of a loss and quickly start some basic assessments of loss, particularly when you can throw the site diagram into the AI along with footage of what's gone on. The AI can probably start calculating losses and what they could be to give insurers an early indication on loss assessment. It's really unlimited in what the technology could do in the future. Look, the industry, I still think's very behind the 8 ball when it comes to technology. They're very slow moving, the insurance industry. I think when you compare the insurance industry to the banks and some of the other financial services businesses, we're certainly not as advanced as them. We're still doing things very old fashioned. I still think the Australian market probably, when you compare it to the Lloyd's market, is probably a lot more advanced with our technology platforms. And it's getting better and better all the time. Certainly the technology platform the Insurance Advisor give us is market leading, no doubt. A very modern and great interface, which gives us access to a whole bunch of risk tools that we can roll out to our clients in terms of identifying risk profiles for their specific site, which helps us a lot. I think that'd be the major one. That certainly artificial intelligence is going to play a huge role in all aspects of insurance in terms of at the underwriting end, at the front end, and also at the back end with claims, in terms of, you could probably see more low valued claims being processed by an AI agent in the future rather than a physical person.
Look, absolutely, I 100% agree, and I think I'll end it on the fact that it's so easy to think property insurance is just so traditional and easy to transact. But when you've got an advisor who has managed claims, who has had experience in putting together complex programs, in negotiating with underwriters around particular construction materials or protection or different types of occupations, that's what makes the real difference for clients in getting better results. And I think working with an advisor, particularly with the tools that Insurance AdvisorNet provide us with the value that we can give clients on key perils, whatever particular to their location, is incredibly beneficial, and clients, obviously benefit greatly from it.
I think information's really important, and I think as brokers, what we do best is just educate, and there's no point educating a client after the loss. You really need to educate clients up front and make them understand what they're buying, how they're buying it, why they're buying it, the methodology for why we do things certain ways, so then they're on the journey with you, rather than just sort of presenting them a program and a cost and please pay here kind of thing. So that's what I'm big on. I like to educate my clients so they understand what they're buying prior to something happening. And again, like insurance, like anything in life, it's about expectation. So if the way to manage expectations is to educate. So once a client's educated, then when the loss occurs, they have a fair understanding on how it's going to pan out and what decisions they've made or haven't made that may lead to the outcome at claims time.
Perfect. Well, Anthony, thank you for coming on the show. It's been an absolute pleasure. Again, I understand property is very traditional, but naturally the experience that you bring to the table in managing that particular line of business is second to none, and it's been great to have you on the show. So thank you, mate.
Thanks, Bill. Cheers. Thanks for having me.
Appreciate it.
Awesome.